Hello and welcome to Wall Street Confidential. This is George Moriarty, executive editor of Street.com, here with markets columnist Jim Cramer. Welcome, Jim.
Thank you, George.
So here we go. We get some retail numbers today. Sears Holdings comes out and
That's a disaster. It's a horrible number. I don't want to defend bad numbers. It's as bad a number as Lowe's, as bad a number as Home Depot. Eddie's not doing a good job running the operation. Alan Lewis is not doing a good job as the CEO. Sometimes it's just better to admit it. I have to believe that there'll be action taken by Eddie. So far, the Sears Kmart integration is awful, and it's better just to admit it than it is to fight it. Stock's up. I wouldn't sell the stock in the same way that I wouldn't sell Berkshire Hathaway after the disaster that was General Re Goodbye. But it's bad. I want to talk about something, a trend that I'm seeing. Guess is up today, Cruise up today, but most importantly, Ralph Lauren's up today.
Good, because I wanted to touch on how retail fits into the overall health of the economy.
I think there's a change in the intellectual property. Let me analogize to something that's just better analogize. In the 80s, it became clear that the real meat of what's in a computer is more important than the computer itself. That Dell's a packager, that at that point Gateway was a packager, and that the intellectual property of Intel and Microsoft was in a tug of war with the PC makers, and Intel and Microsoft won it. Right now I'm seeing a tug of war between Ralph Lauren, in particular Guess also, but Ralph Lauren, where I see Ralph Lauren taking the actual gross margin away from Federated and from JCPenney and from Kohl's, because Ralph Lauren's up big. At the same time, retail's bad. VF Corp, exact same thing. These guys have now been able to take a level of brand and been able to get the gross margin away from JCPenney and toward Ralph Lauren. The Ralph Lauren quarter is amazing because the instant analysis of it was it a bad quarter. And it's a bad quarter because they're spending money. And this is, again, one of the dichotomies we talked about earlier with Google versus Yahoo. One of the dichotomies is that the shareholders want the wrong thing. The shareholders want buybacks. There are very few managements that are forward enough looking to be able to challenge that presumption. Ralph Lauren is. Ralph Lauren recognizes exactly what I'm talking about, which is that the Intel and Microsoft of this year is Ralph Lauren VF. They can take the margins away from the people who have the doors, Federated, JCPenney. And the Ralph Lauren growth, not liked by the analysts and big institutions, but recognized in the headline numbers, as in the Wall Street Journal story today about Ralph Lauren, that they're doing really well. And the reason is because they're taking the money away from the retailers. And that's why Ralph Lauren's up. I want to make a bold statement. I think Ralph Lauren's can be up 30 or 40 points over that quarter. 30 or 40 points. Everything is right there.
Now let's explain something real quick. When you say they're taking the gross margin away, how are they doing it? How
okay.
Are they getting that?
They are providing. Let's take the case of this American remake that Ralph Lauren's doing for JCPenney. They're offering a very special product to JCPenney, which is going to be American Living. It's going to be in each part. It's going to be furniture. It's going to be clothes. And their brand equity is worth more than the store's brand equity. So it's a partnership. It's no longer like that they're footballing suppliers. JCPenney is not able to say to VF, listen, these guys at Ralph Lauren won't come in for X. Can you come in at 10% less than X? They have the brand equity, and so they're able to get higher gross margins, and the store's margins will be squeezed. But that's the beauty of the Ralph Lauren Intel, Microsoft-like theory.
And are they structuring the deals similarly to some of the early ones, like Sears bringing Land's End into their stores?
No, I mean, it's much better. It's when Land's End in the end had to be captured by Sears. Again, Sears is doing so often, it's scary. I mean, especially as a stock that I own fractionally supposed to go. I mean, I don't even care. Right. I didn't care because Home Depot's doing so badly, it's scary. And Lowe's, it's just an industry trend, and what Sears is worse, but it's always been a worse operator. Right. I just think that the focus here is Ralph Lauren and VF Corp have mastered the moment, and those stocks are going to be up stocks, even if retail's really bad. And that's the thing to recognize. The places that they sold to did badly. Right. But they did well, and the answer is because they are able to capitalize off their brands, their aspirational brands, and that's brilliant and it's new.
So you gave us the upside on Ralph Lauren, what's the upside for VF?
And VF can be up 20, 30, too. These companies are changing. Their multiples are going to begin to reflect the fact that they have the Microsoft-like multiple for what Microsoft had in the 90s. People aren't looking at it that way. They should be.
Fantastic. Jim, thanks so much. That's Wall Street Confidential. I'm George Moriarty. He's Jim Cramer. Stay tuned for more on Street.com TV.